Have you ever wondered how to invest in the stock market? The thought can be overwhelming, especially if you're just starting out. But fear not, we're here to simplify the process and guide you towards confident investing. By the end of this video, you'll have a clear understanding of the stock market and how to make it work for you. Now, there are many ways to earn money from the stock market. You might have heard of long-term stocks, mutual funds, or even trading. Each of these avenues has its own set of risks and rewards, and it's important to understand them before diving in headfirst. But don't worry, we'll unpack each of these in detail as we go along. Let's start with the basics though. What is a stock? In simple terms, a stock represents a share in the ownership of a company. When you buy a stock, you're buying a piece of that company, making you a shareholder. Companies like Reliance, Tata Motors, TCS, and Hindustan Unilever are just a few examples of the thousands of companies you can buy stocks from. But why would a company sell its shares? Well, let's say there's a company named A, and A wants to expand its operations, maybe even go international. To do that, A needs money, a lot of it. One way to raise this money is by selling shares of the company to the public through a process called an initial public offering, or IPO. And what's in it for you, the investor? Well, as the company grows and expands, so does the value of your shares. And that, in essence, is how you make money from the stock market. But it's not as simple as buying shares and sitting back. You need to understand the company you're investing in, its market capitalization, and how it fits into your overall investment strategy. And that's exactly what we'll cover in the upcoming sections. So let's dive into the world of stock market investing, starting with understanding what a stock is. First off, what is a stock? In simple terms, a stock represents a small piece of ownership in a company. When you purchase a stock, you're buying into the company's success or failure. You essentially become a shareholder, a part owner of that business. Think about companies like Reliance, Tata Motors, TCS, Hindustan Unilever. Each of these companies has stocks that anyone can buy. When you buy a stock from any of these companies, you're buying a piece of that company's future. You're betting on their strategies, their leadership, their products and services, and their capacity to generate profits. In essence, you're not just buying a piece of paper or a digital token. You're buying a share of a living, breathing entity with its own goals and ambitions. You're investing in its potential to grow and expand, and in doing so, increase the value of your stock. Now that we know what a stock is, let's understand why companies sell their shares. Ever wondered why a company would sell its shares? Let's dive into this intriguing world of finance. When a company is looking to grow, whether that's expanding into new markets or developing new products, it needs funds. This is where selling shares comes into play. Imagine Company A, a thriving entity in need of cash to boost its operations. The company has two main options. Firstly, it could take on debt, which is essentially borrowing money that will need to be paid back with interest. But the risk here is high. If the company goes under, the debt still needs to be repaid, a daunting prospect for any business. The second option is selling shares through an initial public offering, or IPO. This involves offering a portion of the company to the public, turning individuals into shareholders. The money raised directly fuels the company's expansion plans. So when you buy a company's stock, you're essentially helping the company grow and expand. Now let's talk about something called market capitalization. This term might sound a bit intimidating, but it's quite simple really. It refers to the overall size of a company, giving us a clear picture of how big or small a company is. But here's the catch. You can't determine the size of a company just by looking at its share price. No, it's not that simple. For this, we need to delve into its market capitalization. So what exactly is market capitalization? Picture it as a giant scale, weighing the entire value of a company. It's calculated by multiplying the company's share price by the total number of its outstanding shares. This gives us an idea about the company's worth, and more importantly, its capacity to withstand market upheavals. Now, why is market capitalization important when selecting stocks? Well, it's like choosing a ship for a voyage. You'd want to know the size of the ship before setting sail, right? A larger ship, or in our case, a company with a larger market cap, is likely to weather storms better than a smaller one. It's about understanding the risk involved and the potential for growth. Based on market capitalization, companies are often categorized into three types: large cap, mid cap, and small cap. Large cap companies are those mammoth entities you often hear about in the news. Their market cap generally exceeds 20,000 crores. These companies are deemed safer for investment as they are more stable and less likely to be swayed by market volatility. Next up, we have mid-cap companies. These are the middle children, not too big, not too small. They present a balanced mix of risk and return. Lastly, we have small-cap companies. These are often newer or smaller firms with a market cap of less than 5,000 crores. While they offer the potential for high growth, they also come with a higher risk. Remember, understanding the risk and potential growth of a company, as indicated by its market capitalization, is crucial in making smart investment decisions. Remember, the share price alone can't tell us whether a company is big or small, but market capitalization, which is the total value of all a company's shares, can give us a clear picture. This knowledge, while elementary, forms the cornerstone of smart investing. Now, you can confidently analyze and select stocks, aware of what you're investing in and why. With this knowledge, you're well on your way to making informed decisions when investing in the stock market.